It's time now for the Gem Young Wealthcast. Brought to you by Gem Young Insurance and Wealth Advisors, a family-owned independent insurance and financial planning agency since 1947. Now, from their studio on Star Center Drive in Canfield, Ohio, here's the host of your program, Leo Daprile.
Welcome to the Gem Young Wealthcast. This is Leo Daprile. It's hard to believe that it's 2026 already, but here we are. So we're kicking off our monthly series with our analysts, our quarterly series with our analysts. And again, I have probably one of my favorites, longtime friend of mine, one of the brightest minds in the business is Phil Blancato. Phil's the president and chief executive officer of Ladenburg Thalmann Asset Management. He's also the chief market strategist for Osaic. I finally got it right, Phil.
Yes, you did.
How you doing, buddy? Happy New Year.
I'm well. I don't know if you know this. I have a fun new thing to talk about. I'm not one to give myself my own accolades, but maybe today it's appropriate. I don't know if you know, I was nominated as Chief Investment Officer of the Year by Think Advisor magazine. It's actually called the Luminary Award.
Wow.
And in my industry, it's kind of a big deal. So it's kind of fun. So I got another title that no one's going to care about but me and you, but I thought I'd tell you about that.
That's awesome. Thanks for letting me know that. I didn't know that. And good for you. It's well earned. You've been very effective in this industry for a long time, and it's nice to see that your work and efforts being recognized. So, and all of our listeners, and I got to tell you, Phil, the podcast has really gotten some traction. Our listenership's really going up substantially in the last couple of months. So, that's why I wanted to take time to introduce you again, because of the amount of new listeners that we have lately that may not know of you, but they should get to know you in the work that you do. So, anyhow, here we are.
I appreciate that. Here we are.
Yeah, here we are, man. I will start with a couple of things by saying, when we started the year, we talked about this a little last quarter, that all the predictions you made over the last 3 quarters of the year have proved to have been right. You were spot on with everything. You were spot on about excessive market volatility coming in the first 6 months, which we didn't know why, but we had it. Nonetheless, we had it, right? You thought we'd finish the year strong, and we have. You thought last quarter that we were priced pretty well, but there was still some room to grow, and you were right on that. So these are all the reasons you won that award, Phil.
Maybe so. Thank you. Yeah, I guess so. Thank you.
And I like to say it's people like you and I that have been around for a long time that. One of the things, and I tell my staff this all the time, that part of what makes me good at what I do is the gray hair, meaning I just been around long enough, right?
Yeah.
We've seen enough things, and you process on a daily basis an enormous amount of data, and you're constantly processing this through to help formulate your positions and your decisions. And after doing it for as many decades as you've been doing it, you look at it a little bit differently. You know what's relevant. You know what's noise, what's not. Because I was having this conversation, Phil, lately with my clients. When it comes to decision making, everybody brings bias into a decision making process, right? And it's not, yeah. When I use the word bias, we typically associate that with something negative, but it's not. Bias is, again, the way we're raised, the environment we grew up, our economic and social economic status, all that comes into a bias. So we could all look at information, the same raw data, and come to it from different angles, right? So from your point of view, how do you decipher those biases when you're making decisions?
It's funny, you hit on probably one of the most critical things I spend a lot of time on. By the way, the reason why I don't have gray hair is because I use this shampoo that makes it less gray. Otherwise, I'd be more gray with you. Some of the folks might catch me on TV. I do a lot of TV stuff, so I'm a little vain on that. I don't know if I'm admitting it. That at 58 years old, I prefer to be a little less gray.
Looks good on you, Phil.
I appreciate that. Well, it's funny. That sort of plays that mindset of, how do I eliminate emotion from investing? Because what you're hitting on after doing this for 35 years is your bias is directly connected to your emotions. So if you're looking at an election cycle and how passionate people can be around elections, you look at that, AI being this 4th industrial revolution or another big bubble, you got to boil it down to some of the basic fundamentals of investing, which is most of the time markets rhyme. History periods of time in markets tend to be very similar. You can always draw a beginning of a conclusion from what happened in the past. It's really critical that you don't use that phrase, it's different this time, because rarely is it ever really different. So first you start there. You want to make sure when it comes to your bias that you don't try and pretend that it's so different that you're willing to throw out the metrics that got us here in the first place. So you want to be smart about what's a fairly valued opportunity, how expensive are markets, where are real earnings growth, how much is euphoria in stock prices versus reality, and then most importantly, in order to take your emotions, your bias out of it, you have to kind of come back to center every single day and challenge your thesis. So in other words, you don't want to make a decision and fall in love with it simply because you made a decision at this point, you're convinced it's right, and you're willing to stick to it regardless. Sometimes you have to pivot. Sometimes your thesis, whether you got to it wrong or right, has to be nimble. It has to change. And I think sometimes folks get so, for example, look at Tesla stock. We saw really bad moments in 2025, and then we saw an all-time high. But if you look at the real overall growth, we haven't hit all-time highs in Tesla in a long, long time. So the reason why I mentioned that, there's legions of people that are convinced that that tremendous growth they got in Tesla for many, many years is going to continue. It doesn't really work that way. It's really hard to make a $2 trillion company a $4 trillion company. It's a lot of horsepower, a lot of energy, a lot of sales, a lot of price improvement. So my point is, you have to come back to center on a regular basis. Start with history, keep it to the facts, and then challenge yourself to make sure you got it right. And when you got it wrong, make sure you're willing to change.
I think that's what separates the real pros from the wannabe pros when it comes to managing money. Is the good pros know when to say, okay, that was a wrong decision. Let's cut our losses, move on, right?
Exactly.
In the average human condition, not that it's wrong, it's flawed when it comes to investing money, is, our value system. I've talked about this a lot, Phil, on the podcast, that says, investors as a general rule do worse on their own because they take these biases on how they were raised. Buy good stuff, take care of your stuff, right? Don't make impulsive decisions. All good principles to be raised by and to raise our children by. But when you apply those principles to managing money, what I'll do with my clients is I'll say, if I showed you an investment that had a negative return of 10% last year, and I'm saying, I want you to invest in it, what's your initial response? And most of the time, their response is, oh, I'm not buying that, just losing money. And I say, isn't that buying low? There was your opportunity, but your bias got in the way of it. So you tend to wait, people tend to see things going up, and then they buy it. Then when it goes up some more, all it does emotionally is reaffirm that they made a good decision. And now they own it, right? So when it starts to go through its typical cycle and starts to decline again, they hold it because, it'll come back. It was a good decision 2 years ago. And then it gets past their pain point of their risk tolerance. Then they say, I want to get out of this before I lose all my money. So that's why I say the average investor left to their own devices loses more money than they make, because how they bring emotion into it, and how that clouds what their decisions are. So I'm just saying that's how I take that down to a client level and have them think about the decisions and why we don't do that. And the reason that I'm bringing this up today and wanted to talk about it today is we go into 26, right? We've had 4 really strong years in the market. So what does everybody say that comes into my office, Phil? Okay, when's the next correction coming? This can't go on forever, right? And the markets are new highs again. Gosh, I don't want to invest now. I want to wait for the dip or correction, which we know that's impossible.
We all like a bargain, Leo. That's the problem. It's very hard to do. Everyone likes a bargain, but I'm sorry to interrupt.
No, go ahead.
Help myself, because you're right on. And here's the irony of that. Everyone wants to buy a dip because they're concerned about buying at the high because they don't want to lose money. Well, the reality is there's a phrase I use a lot, and it's really very simple. The last thing you want to do is fall in love with the stock market, because the stock market doesn't love you. You shouldn't love it. If you become non-emotional, or more importantly, don't panic when you're investing your money. Highs and lows in markets are normal. They happen. It's when we panic that we make profound mistakes. So to that client that comes in, I don't want to invest here because they don't want to feel that panic if their money starts to go down. And that's the flaw. That's how people like me make money, because we never panic. We take advantage of those opportunities rather than panic. And that's the classic difference between someone who just does it kind of here and there, gets really emotional about it, versus I don't. My singular focus is to make money regardless of what's happening in markets. And I think that's the profound difference.
You know, Phil, and where I see it a lot is, especially over the last decade, people have 401k balances now that they never dreamed of having.
Yeah.
So, and for many people, that's their largest investment asset is their 401k. And now they're looking at it. Now they feel pressure because the numbers have gotten big in their mind. And now they're even more afraid of making that mistake. So that's where I see the average investor making more of those irrational trades out of, and let's be honest, most 401ks, your investment alternatives within that are mutual funds, right?
Mm-hmm.
So they're moving in and out of those, which actually puts more pressure on the managers because when people are wanting to get out of things, as you know, it forces the mutual fund manager to sell things at a time and price they don't want to because somebody panicked, right? Which hurts the long-term shareholder, right? Because they're in for a different perspective. So let's start with, okay, now that we're here, I'm going to do things in reverse. Normally we'll say, let's do a recap of the year. But since we're here, where do you see 26 going? Because when someone says, okay, Phil, we've had 4 strong years, when's the party over? And what should I be concerned about now? What are you saying to them?
I want you to channel your inner Rip Van Winkle. I want you to fall asleep on January 1st, and I want you to wake up on January 1st, 2027, and your account's going to be up. Because in between the two, it's not going to be fun. And the reason why, I'm gonna do a simple analogy that maybe folks can relate to. I want you to think about when you walk into your local grocery, or your supermarket, and you walk in there and there's a box of cereal that you really like, and it's been in short supply. Everyone bought it. It's really popular. It's gotten really expensive. It doubled in price, maybe tripled in price, maybe quadrupled in price. And unfortunately, everyone wants that box of cereal, and so do you. So what do? You keep buying that cereal. Well, then finally you get to a point where, you kind of get tired of spending that extra money. The cereal is kind of boring to you now. It's not as exciting as it once was. And you pivot towards other boxes of cereal that might be due. Maybe they're down on the sell rack. Maybe they're at the bottom and they're cheaper because you're struggling to, maybe things that got a little tight after the holiday season. So in other words, what I'm drawing the conclusion is to the Magnificent Seven. At a time when we saw the Magnificent Seven really be the far and away the dominant force in the stock market for the better part of the last 10 years, certainly the last 5, that those 7 represent the bulk of the return of the S&P 500. 40% of the weight, those 7 combined are 40% of the weight of the S&P 500, make up, if you look at all the stocks combined, and we're the biggest. So you have this scenario where in order for them to continue to grow, you would need to make NVIDIA today, which is a $5 trillion company, a $10 trillion company. That's kind of hard to imagine. It's almost impossible. The math just doesn't work. So the reason why I think that's my Rip Van Winkle story here, or my grocery store analogy, is other stocks in the S&P 500, other cereal boxes, are other places to invest. Except these other companies don't come with these tremendous growth rates that you saw in the Magnificent Seven. So what it means is we're going back to normal. And in any normal year, the stock market does about 8% at best. We see at least 3 corrections in 1 year of 5%. I would expect in 26 to have at least one good 15% correction. Why? Because the Magnificent Seven are priced to perfection. They're priced as if they're always going to continue to make money. And we know that's just not the case. In fact, I'll give you a fun stat. If you look at the top 10 stocks in the S&P 500 today, there's only one that was in the top 10 years ago. So things change, especially in the world of AI. There's going to be a bloodbath in AI. There's going to be winners and losers, like in every industry. It's not a bubble, but there's going to be some companies that are profoundly good at it and sustain their growth and do really well, and some that just aren't, and they're going to go away, not any different than the years after the tech bubble. I'm not suggesting this is the tech bubble like 2000, but you remember that period of 2004, 5, 6, 7, when we got to 2010, there were a lot of internet companies that went bust, and some became the behemoths, Amazon, like they are today. So that cycle it's time for it to kick in. The euphoria of AI is over. The reality of AI is here. And what that means is you have this scenario where the market's going to be volatile. I do think we end the year at 7,500 on the S&P 500. That's about an 8% rate of return. And the reason why is I think the other stocks in the S&P 500 are going to do well for 3 reasons. Well, I did four. 3 reasons. Lower taxes. Everyone's getting a tax break. Whether you're on the East Coast and the West Coast and your SALT taxes are going higher, tax on tip, tax on Social Security, a lower cost across the board. Now, I know lots of folks didn't like the bill, but the bill did have a tax break in it for just about everybody. And I guess that's why some folks didn't like it. But the reality is the wealthiest Americans spend the most, so they got a break as well. Secondarily, the ability to create new manufacturing opportunities in the United States where you literally have, and it doesn't have to be just manufacturing. Let me explain what this means. It's really important. You basically lowered corporate taxes because the bill in and of itself, the most important thing about the bill that was so powerful, and it starts in really April of 2026 to kick in and goes forward is, let's say if your company, Leo, let's say you all decide you want to launch a second practice and you want to do it in New Jersey and you're going to buy a building, you're going to hire a bunch of people and you're going to put them all to work and it costs you $1 million to do that. That $1 million is immediately deductible from the total revenue of your company. So what you effectively do is you spend money to grow your company and lower your taxes. That's a very powerful phenomenon. What that does is bring manufacturing back, bring business expansion back, because the ability to use your current money and reduce your tax base. What does it do? Lower corporate taxes. Why that's so powerful? AstraZeneca. AstraZeneca is a great example of a French company who is arguably the #1 cancer-creating drug company in the world. We could debate that. But they certainly have some of the prolific cancer drugs in the world. Well, they did not have a U.S. manufacturing facility. They announced late in 2025 that they're building 2 plants, one in Maryland, one in Virginia, that'll cost upwards of $5 billion for both plants, hire in excess of 10,000 workers that'll probably make somewhere around $100,000 a year. Here's the key. That $5 billion is immediately deductible from AstraZeneca's top line revenue. What did you just do? You lower the tax on those corporations. What do they do when that means? They hire more people, they pay higher wages. It's a very important part of the U.S. economy in 2026. We're in this experiment, and this experiment works, where you get a rebound in investment in the United States. That's a game changer. And the third one is the inflation debate is basically over. I'm 58 years old. You and I are similar in age. I grew up with inflation right around 4% for the better part of the 80s. We're now under 3%. And I don't know that it's going to go back to 2 in 2026, but if AI it gives us a boost in productivity, which we expect, and I do think demographics, how old the country is and who has the money, causes less spending to a degree. That means we slow down in overall inflation. Wages go back to normal. We see inflation settle in 2.5% probably. It means the Federal Reserve cuts interest rates 2 times in 2026. That brings interest rates to borrow money to 3%. That means your mortgages go below 6%. Your car loans go below 6%. It means your credit card loans will go back under, depending on your ability, 15 to 20%. So what it means is that's a huge stimulus. Lower interest rates are a stimulus for small companies that grow, stimulus for the consumer. Those sort of things are very powerful. And the problem, why we're going to get a really significant correction, back to my cereal box analogy, this is going to take time for those other 493 to grow, support the market, prove that they're worth investing in, make the money there. Along the way, you're going to have winners and losers in AI. The Mag 7 don't grow as fast. We get a couple corrections because of the missed earnings cycles here and there, but end the year on a positive tone because of the things I already mentioned.
You know, I'm glad you brought up pricing to perfection, because back in October, Stephen and I we did a podcast and we had a big discussion on that, where I felt that things had to be perfect to justify the current pricing. And that never works out that way. And it's back to one of the terms you and I have always used in the past is, for economies to continue to accelerate, there needs to be confidence. When we get in trouble is when the world becomes static, right? And we cross over from confidence to euphoria, right? Like you said, in the perfect example, and again, this is my chief compliance officer hat on again. We talk about companies in terms of an explanation, but never a public recommendation for any of that stuff. We just use them to illustrate an example. So, okay, I'm happy now. Thanks for letting me put that in there. And Jamie would be happy with that, don't you think?
I think so. I think she'd be very happy with that.
Yeah.
That's funny.
So that's kind of where I saw the balance. But Phil, there's a couple of interesting points that you brought up. And this is kind of where I'm at on AI. You know, you and I have been around long enough that we saw the .com bubble. But the reality is the internet was the thing, and the internet changed the world. All the companies back then on how they thought they were going to change the world. A lot of them were flashes in the pan. Back in the day, it was companies going public and just to raise the money that had no real plan and didn't show that they were even making money. But people bought it because they want nobody, the old FOMO, right? People didn't want to be left behind. So Today it's a different world where you have private equity funding it before it gets public. So there's a lot of that money going into those businesses. So the companies in the AI space that are failing, that aren't public, that are private equity money, we don't really even know who they are. So that's I think that's a little different. And I agree that AI's like the internet it's going to be around forever. It's going to have a significant impact on people's lives and the economy. But the analysis I use even with my own staff is if you look at 0% adoption to 100% adoption, it's never either of those. We're going to end up somewhere in between with that adoption and utilization of it. And we don't really know what that's going to look like just yet. So that's why I'm glad to hear you say we're going from the euphoria in AI down to reality. Because the other point that we talked about earlier in the fall was when all these companies, AI companies, and the related companies with them were going up in values. They're announcing these multi-billion-dollar plants they're going to build. This is the old guy in me, Phil, going, well, who's going to pay for it? How are they going to pay for it? These companies, and Steve's argument at the time was a lot of these companies are flush with cash. I'm like, yeah, but these are not hundreds of millions of dollars. They're talking billions and billions of dollars of transaction, which means there's going to be bonds. There's going to be more debt on these companies. And I think it's going to create a bigger hangover than people expect. Because once they...
Exactly. In fact, let me interrupt for 1 second. Some of you just hit on. It goes back to my point about NVIDIA earlier. How do you make a $5 trillion company generate enough sales to go to 10 trillion? So to your point, all that stuff you need, more bonds, more capital, more investment, more sales, it's never been done before. We've never had a $1 trillion company until recently. Now we've got one that's 5. So we've never seen a company go from 5 trillion to even to 6 trillion. So to your point about perfection, for the folks that are listening, it means imagine if you ran your own business and you had to consistently generate 30% increase in sales per year. That's pretty hard to do. And that's the idea of being price to perfection. Sorry, I couldn't help myself. I think sometimes you and I get lost in this trying to explain what all this mumbo jumbo means. It means you're running the corner store, you're selling candy bars. How many candy bars can you sell in a day to double or triple your revenue? And that's what we're asking of the Mag 7 to do, and it's really very difficult.
Yeah, I got it. Well, believe it or not, it's time for us to take a little break, pay a couple of bills. So this is the first installment of the Gem Young Wealthcast with our analyst season beginning here in January, and I have Phil Blancato with me. All right, I'll be back after the break. This is Leo Daprile, and this is the Gem Young Wealthcast.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
At Gem Young Insurance and Wealth Advisors, we believe your financial goals deserve more than just a plan. They deserve a team. From planning for a work-optional lifestyle to managing risk and supporting your everyday needs. Our financial planners, paraplanners, and service team work together to build a strategy that truly fits your life. Planning for the future? We'll help you make that confident financial decisions and achieve lasting peace of mind. Call Gem Young Insurance and Wealth Advisors today, 330-533-6936, to schedule your fit meeting and start building your financial future.
Now, back to the Jem Young Wealthcast, brought to you by Jem Young Insurance and Wealth Advisors. Once again, here's Leo Daprile.
Welcome back to the Jem Young Wealthcast. This is Leo Daprile. This is our January 2026 Analyst Kickoff Month, and I have one of my favorites with me today. Hi, Phil. Phil Blancato from Ladenburg Thalmann Asset Management. So, been pretty interesting. I want to, before we move on, I want to tie a conversation we had before the break, and we were talking about the AI companies that are taking on a whole bunch of debt to build all these AI data centers, and you spoke earlier about the debt tax deductions that's coming to corporations for investing in America. Do you think that's part of the catalyst for all of these plants to be built, because there's going to be a significant tax deduction for them to spend this capital to do that?
Believe it or not, I'm going to put that secondary. The reason why these data centers are being built, because AI in and of itself takes tremendous amount of information to get to the results that we want it to use. I'll give you a fun example of why the current build out of the data centers is such a big deal. Today, if you use traditional search engines on the internet versus a search engine that uses AI, a search engine using AI takes 10 times the power of every search versus one that was a traditional regular web-based search. So the point is that data centers are critical in order to speed up the answers and get more accurate data, more accurate answers. For example, just for fun, if you look at the top 10 bots today or top 10 large language models, the number one is Anthropic. So Anthropic's hallucination rate, or the number of times it gets it wrong, is 40%. So the most popular one has a 40% error rate. The one that's brand new, that is gaining a lot of popularity because you can do some really wild things on it, it's called Gronk 3. Its error rate is 90%. So you have to have more data centers, and regardless of the tax bill or not, these were going to be built to get AI where it ultimately needs to be. And the downside of this is I think most folks are probably frustrated. I would bet where you live, because Ohio is a big data center area, especially Columbus. I know you guys aren't too close to there, but you may have this in your area. You're seeing euphoria around construction workers going to work on building these centers. You're seeing folks get jobs in the management and of the data in there, the regulation of the cooling, the HVAC. There's all these components to building them and then managing them. But here's the downside. I'm going to guess your average electric bill where you all live is up somewhere between 10 to 18% over the last 12 months. And the reason why is data centers need constant and permanent electricity current. And we just don't have enough power in the grid today to supply them with the power they need. And here's the sad part. Today, they make up 4% of the American electrical grid. It's going to 10 or 12 by 2030. So on one hand, AI, I don't think this is happening because of the bill. I think it's because there's tremendous demand for AI to enhance productivity, to make us all live our lives more effectively, more efficiently, because of the results we get from it and how we can empower it. But at the same token, it's going to come with a hefty price tag for the average person who turns on the lights in their house every day, and for the average investor.
Well, I can tell you that your estimates of the utility increases in the area that I live is accurate. It's more towards the 18 to 20% because of that. There's one community around here that's actually saying no to data centers because of all that comes with it. Not just the build of it, but the demands on it. There was an article recently, I believe it was in the Cleveland Plain Dealer, where they're saying the projections for electric in Ohio and in our current needs today, we don't have enough. We already don't have enough. So these data centers, we just need to build more of the electricity generation plants so that we can even have a conversation for the data centers, right? So I think that's sort of the challenge that we have as well. So even though there's all these, this is, to your point, it's not 2020 again, it's not 2021, it's not the tech bust of what it was. But, this is a euphoric industry. So, things you and I have talked about before is I don't see a general recession coming, but there's always pocket recessions. There's, different industries will go through their own types of recessions. And the data center, what we need by 2030, I don't know if we'll get there. So I think that's going to be a risk to some of these companies that are trying to build these large data centers. I think it's going to take more time to get these things off the ground because the infrastructure, to your point, the electrical infrastructure that we need isn't there to do it. So we could have all the want we want in the world, right? But without having that full picture of what is really needed for everything is a little bit different. So I think that's going to be one of the things that's going to start denting earnings. To your point, in 26, that it's going to be really hard for $5 trillion companies to become $10 trillion companies. Not that it can't, but, and this is what I want listeners to hear, is everybody's, when they buy their stock and it's priced at whatever, $100 a share, everybody wants it to be 200, right? So that's how personally they make that when they own that individual stock. Back to where we started out the podcast of how people emotionally own things that they shouldn't when it comes to their money. So when you have a $5 trillion company that wants to double, what is their sales infrastructure to double 5 trillion to 10 trillion? That's a big ask. So I'm in agreement with you that these large companies are going to continue to be large, profitable, innovative companies, but that growth horsepower is going to be harder and harder to get to.
Yeah, exactly. And I think what some folks, and I'm not trying to be political here, but I would say, I hope we don't get to a place where we're not building data centers, which don't allow the full power of AI to help us because of electrical demands and what it might do for us. And I get why people are angry, but let me give you the other side of this. Think of the number of jobs that will be created in creating new power. Think of the number of jobs that will be created in a new industry that would pay really good wages. Think of one of the reasons why I'm bullish on energy in the next 2 years, 3 years, commodities specifically, is because we'll go back to having power that we need, whether it's wind, water, nuclear, solar, to a degree, certainly gas and oil, maybe even clean coal. But all these things, because as we grow and become more efficient and use more electricity, whether it's for our own personal use or AI, they create these unintended consequences of, yes, it gets more expensive, but the long term can be extremely beneficial. And that's the tug of war. That's exactly your point. This kind of thing can hurt earnings. So if we see this kind of ebb and flow of AI and whether we like it or not, we're going to pay for it, that impacts earnings. That's why the market sells off 5% up to 15 in 2026.
Do you see that as a first 2 quarters scenario or second half of the year scenario?
I think we get through the first quarter pretty well because I'm going to expect the consumer did really well in the fourth quarter. We don't have the data yet, but I think the consumer spent in excess of $1 trillion in the fourth quarter. So I think that's still pretty exciting. The first correction comes sometime, call it March, April time period. That's traditionally a very tough month. Reason why the tax breaks haven't quite kicked in yet. We haven't seen that real implement of what it's going to do for the consumer or for corporations. So we're going to have a bit of a lull in the first few months. We'll probably see some renewed inflationary data. And the reason why I think some of the shutdown issues of 2025 caused some of the year-end data to be a little bit funky. We saw better inflationary numbers, but not convinced they were right. So we're going to see some weird data come out in January, February that are going to be better data. We also got the changing of the guard at the Federal Reserve will be a hot topic. So a lot of things that could spook the markets in those first few months. And by the way, the market not being cheap. If you look at the price of stocks divided by how much companies make, how much they earn, that traditional metric should be about 18. Today, it's around 23. So that's expensive. So you need earnings to catch up to the price of stocks. And how do you do that? Either prices stay stable and earnings grow, or prices come down and earnings grow. And I think that's the first 6 months of the year. Then we really get into the summer months. We see the consumer do really well, assuming the labor market does not get hurt by this. The labor market would be hurt if we have higher for longer interest rates or a return of inflation. And I don't think that's the case, at least as of right now. Assuming the labor market hangs in there, we stay hanging around 5% unemployment, 4.5 to 5. Then we get a really strong summer and a real robust fourth quarter that makes up for the losses and puts us back at 7,500 on the year. So Rip Van Winkle, fall asleep on January 1st, wake up on January 20th. Things will be fine. In between, you and I will talk a lot about it, but I think we're going to be just fine.
All right, so let me go back to 25 for a minute. What do you think, from your point of view with your investment strategies, what were your big winners, and what are the things that kept you up at night?
That's a great question. So couple things we did really well, a couple things we could have been better at, to be quite honest with you. We had an allocation to small cap stocks that, in fairness, the last half of the year were just incredible, and they look like they're going to close the year tied with the S&P for the year. I thought small caps would beat the S&P. They ended up being equal. So surprising that they didn't. The reason why they didn't is the Federal Reserve didn't cut interest rates as much as we thought they would. We thought they would cut a bit more than they did, half of 1% more when they did not. And inflation, in fairness, stuck around a little bit longer than everyone anticipated. Small caps are still waiting for that rally past the S&P 500. I think that's a big component of 2026. The other surprise of 25 was the success of international stock for the first time in really about 15 years, where international stocks beat U.S. stocks by about 10%, depending on sector as much as 13. Now, the reason why they did that is because the currency, the dollar, devalued by about 11%. So you lost 11% in your dollar and you made 13 in the stocks. Let me give you an example of what that means. If you went to Europe today and you used dollars to buy a pocketbook, make it up, I don't know what, my wife certainly likes to do that. So buy a pocketbook in Europe. Well, if the dollar's worth less, you need more dollars to buy that pocketbook. Translate that to stocks. If the dollar goes down, European stocks are simply worth more because they didn't correct and the US dollar did. So in that scenario, that's why international did so well. So we were surprised at how much better it did than U.S. stocks. So we didn't own any. We did add some in the fourth quarter and did quite well in the fourth quarter because we owned it. But that was the two things that were a bit surprising. The one thing that we had exactly right was a big bet on bonds, and bonds had a wonderful year in 2025, up over 8%, returning to what they used to do. In fact, a bit better than what they used to do. So we made a big bet on bonds, and that worked out quite well. When I translate that to 26, I think the bond market's not as good, but I think we could get probably another 5% solid return from the bond market. I think small caps beat U.S. stocks, big large cap stocks. So that's a win for the portfolios for, I think, in 26. And international is finally a place to invest again. They don't have the same growth rate as the United States, but their stocks are cheaper. Going back to my cereal boxes, imagine international stocks are on the first shelf of the cereal box aisle, and U.S. stocks are on the top shelf. So we're trying to invest in the middle shelf and a little bit lower into international to try and find better value. And that makes some sense. I don't expect tremendous growth differences, but a bit higher for international than the U.S.
You know, it's funny because for years we would preach allocation disciplines, and the international markets for so long made that discipline difficult to continue to justify. But it goes back to the old expression of what we say all the time here on the podcast. It's time, not timing. Because so many people, Phil, through the years were just getting frustrated and just trying to go with U.S. large cap growth and mid cap growth because that's where the winners really seem to be. And this year, it's back to one of your successes is the balanced portfolio, right?
Yeah, yep, exactly.
So
balanced portfolios did around 12% for the year. My gosh, that's double what they do historically. That's a really wonderful number. But I think sometimes we get so caught up, and you'll see this. I would bet there's lots of listeners that own lots of shares in NVIDIA or Tesla or Microsoft and all those. And they're going to say to themselves, I'm never going to sell them because these are great companies. Terrible idea. Now, I know you always want to be careful about taxes. You want to make sure you're holding for a long-term gain. And there's ways to mitigate taxes. Leo, I'm sure, could walk you through some of the various ways to do that. But do you really want to be in GE, for example, which was the bellwether name that we grew up with, and then went bankrupt and had to go bankrupt, start all over again? By the way, now it's a great name again because they're in the aerospace space. But certainly, you can imagine there's no reason to fall in love with a company. Look at IBM. Look at when IBM was the only thing we ever talked about when it came to technology. They're not even in the technology conversation. So you really don't want to fall in love with a name. You want to take your profits and pivot to other areas to, one, reduce risk. To Leo's point, my formula is simple. Risk plus time equals reward. So there's time in the market. How much risk can you could afford? And that's how we make you money. And if you're willing to adhere to that, you can do quite well.
Well, you put it easy, but it's way more complicated than that on how you guys do things. And it's the research, it's the CFAs you have on staff that support your thinking, that do a lot of the due diligence work. And I love to read your research reports because they're so interesting, because you always are talking to the bulls, the bears, and you just never sit there and take one person's point of view and your ability to adapt and change. So going forward, we all know that for years and years and years, the balanced portfolio was just hard to really make any decent money out of because bonds were 0 to 2% in their returns. And for that, the moderate investor is a moderate investor no matter what's going on in the market, right? So there was a lot of investors that just kind of took it on the chin, if you will, right? Because for them to just stay within their risk category and their risk profile. And they finally got some reward. And I think going forward, Phil, like you said, you're kind of looking like maybe a 5% return in the bond market in 26. That's a heck of a lot better than it was 3 years ago, 4 years ago. So I think the balanced investor is going to get back to getting more returns that are commensurate to where they should be. And I don't, because we were setting expectations during those times when interest rates were paying next to nothing, that, those are going to return 4 to 6% because you might have 10 or 12% performance out of the equity part of your portfolio, but you were earning so little on the bond part of your portfolio, just diluted overall return. So it's kind of been a punitive place to be that when interest rates were next to nothing, that I think now that the average balanced investor, moderate investor, kind of finally has a place to be where they can earn some respectable returns.
Yeah, you're right. And that's where I know you're an expert in insurance. I think we're going to get back to a time in a couple of years where bonds are only going to probably go back to doing 2-3%, maybe 4%. And maybe you complement your portfolio with a high yielding fixed annuity or variable annuity, or using alternatives in the portfolios today. The birth of alternative investing that allows us to put different types of higher risky securities, we call them interval funds, as an example, or private equity, private credit, that we could put in a portfolio to get greater yields when as a time we go back to normal in the bond market of 3 to 4% annual rates of return. Well, if we want to complement that with a 6 or a 7% higher yielding product, I think we're going to need to do that in the years to come. Not yet, but I can see that as being part of the portfolio lineup for investors who are willing to take a little more risk, but get better reward for it.
So you spoke a little bit about what you think 26 is going to look like and how the Magnificent Seven is going to have a hard time just to continue to accelerate because they've accelerated so much. And like you said, there's 493 other companies in the S&P 500, especially if interest rates go down, create more opportunities. Are there sectors that you're seeing, Phil, that you think are breakout sectors? Like you brought up international and small cap for 25. Do you have any of those themes for 26?
I do. I think there's a couple areas you want to think about that are exciting for 26. That first off, I think on a broad basis, I do think there's a pivot from all things AI to other areas of the market, as I mentioned. But then I think U.S. GDP hangs in there fairly well. The one of having a year where U.S. GDP could easily come in 2.5 to 3%, which would be really very impressive and very supportive of the dollar and the U.S. bond market. But then you break that down to the portfolio level. First one's commodities. I think having a commodity exposure where you're specifically getting things like copper, maybe to a degree silver, some of the metals that we need in aluminum, zinc, plutonium, platinum, obviously all these things that are be a part of a manufacturing renaissance globally and domestically. The whole globe wants to tear down their power grid, their electric lines, and rebuild them. Why? Because you want greater efficiency. You can't have power, the drain by moving power from Columbus to Toledo, for example. If that's the case, where the power plant is, every time you go across a power line, it loses its potency, its amperage. So you have to have better lines. Well, that's a whole new industry. Then you add that, okay, how about the materials for a data center or a nuclear power plant and so on. I think there's a real opportunity in commodities again, and we haven't seen one of those in a long time. Really, last time we had a commodity super cycle was 2000 to 2007. So I think there's a chance to be in commodities and do well. And then beyond that, from a sector standpoint, I think you can do really well in energy and healthcare. Those are two areas that, besides tech's not going anywhere. You're still going to do fine in it. Aside to a degree, communication services, you'll still do fine in it. But healthcare, we're vastly underserved in the healthcare space from people we need to hire. And I think that the overlap of AI and healthcare for the new drug industry is going to be incredible. The effectiveness of bringing drugs to market that'll be faster, will be at warp speed because of AI. But then more importantly, the ability to use AI to diagnose a patient much more efficiently, I think that's very powerful. So I think healthcare has a real lift. Winners and losers, not everything. And then energy, as I mentioned, because of this insatiable demand that we have for it.
Okay, let's talk about gold. Everybody wants to talk about gold. What's your point of view on it?
So let's define what gold is. Gold has a perception of value, like silver has a perception of value. Silver's used a little bit in manufacturing, not a heck of a lot. Gold, basically not at all. So when I say perception of value, what you perceive gold to be worth and what I perceive it to be worth are different. It doesn't create anything. It doesn't make any money. It doesn't pay a dividend. You don't use it in manufacturing. I guess you can make a piece of jewelry on it, but then again, that jewelry is priced based on the weight of the gold, not how pretty it looks generally. So you have this scenario where this limited supply of a particular commodity, could be Bitcoin, by the way, or gold, either one, a limited supply of them creates a perception of value because you can't make more gold. You can make more diamonds now, by the way. You know how diamonds have gotten murdered because they're no longer a limited commodity because you can make a man-made one that's as good as a nature-made. Ladies, don't get mad at me, but those are the facts.
Yeah,
My point is,
lab grown is for the we used to call it cubic zirconium. Remember?
Yeah, they were the real fake ones. Now the real fake ones are real diamonds. But when it comes to gold, the reason why it's different this time, and what I said earlier, you should never say that, but there is a reason to start here, is because we bought gold over the decades when inflation was higher. Why? Because gold had monetary value when other currencies were debasing or being valued less because of runaway inflation. Example, the late 70s into the 80s, when the inflation was running rampant in the United States, gold went to all-time highs. Now, gold has been terrible since then because we just haven't had runaway inflation. Why is gold now up to its all-time high? By the way, just finally got back to where it was in 1975. The reason why is it up when we don't have a lot of inflation in the U.S. economy? Something is different, and it's not that. And I hate to use those words. The difference is every single country in the world has gone on a debt binge, and the debt binge began in 2008, where every country in the world, every developed country, printed money to hold up their economy, and it was exacerbated, made worse in 2020. So suddenly, all this excess debt, the United States, $31 trillion in debt. You know, for every dollar we make, we owe a dollar. We can go on. Japan, for every dollar they make, they probably owe $2. China, for every dollar they make, they owe $1.50. France, a debt time bomb. So all that pivoted money back to the gold because rather than buy American dollars to invest in, people, central banks and investors bought gold because of its perception of value and its limited supply. That's a really long answer, but it's doing something it never did before. Go up in value when interest rate and inflation is down. So it's a phenomenon that no one really saw coming. Granted, it's buying season for China, wedding season, buying season for India, wedding season. That played into it a little well for physical gold jewelry. But the reality is it's done something it's never done before, and we don't own it. But to be honest with you, if this continues, gold has got another 100% increase ahead of it. And the reason why, because if the rest of the world, including the United States, can get their budgets balanced, well then, hey, then this thing goes down. But if we don't, and I'm not convinced we will, then it's going to keep going higher.
Awesome. All right, my friend, I am out of time again. I want to say thank you for coming on again. It went quick like it always does. All right, Phil. Phil Blancato, the President and Chief Executive Officer of Ladenburg Thalmann Asset Management. Phil, thanks again, man. We'll talk to you soon. All right.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo Daprile.
Welcome back to the Gem Young Wealthcast. This is Leo Daprile. Well, there you have it. Round one of our analyst conversation started already here in 2026. And I love starting things, especially with Phil. He's normally the first guy up. Had a lot of interesting perspectives, I thought, for the year. And where we're going this year. It was a great discussion on artificial intelligence. That's kind of how we are in the investment game. We're kind of seeing it like we're getting to the hangover phase of it, the euphoric phase of it. So what I want to impress upon you is the need for diversification in your portfolios. There was a lot of big winners in 25, and a lot of those big winners are going to be more difficult to come by in 26, especially if interest rates keep coming down. It's interesting to see that he's expecting another good year. So this, he's projecting this is going to be 5 in a row. So this is uncharted territory for many of us, but there's a fundamentally sound economy, and the information that he's putting out there and the data that they're putting together is giving them that. But like he said, his Rip Van Winkle analogy is it's going to be volatile getting there. So just be smart. Make sure you're allocated, making sure you're talking to your pros and that you have everything lined up the way you need to do it. So until next week, I just want to say thanks for listening today. It was a great podcast. Always love having Phil on the show. So, all right, this is Leo Daprile. This is the Gem Young Wealthcast. Until next time.
Planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
Join me every week where we talk anything and everything about your money. Have a topic you want to hear more about? Email Katie, that's Kayti, at gemyoung.com. You can find us on Apple, Spotify, and the iHeartRadio apps. Until next time, this is Leo Daprile.